Example 6. Effect of capitalized interest cost on coverage ratios and cash flows. Melco Resorts and Entertainment Limited, a Hong Kong SAR-based casino company which is listed on the Nasdaq Stock Exchange and prepares financial reports under US GAAP, disclosed the following information in one of the footnotes to its 2017 financial statement. Now we can read this over here, but over here we are already given the data. So the EBIT is 544,865 for 2017, and these are the important numbers. So this one is your capitalized interest, because you are capitalizing your interest, and this is your amortization of deferred financing costs that will be used to reduce your EBIT. Now the first question is, calculate and interpret Melco's interest coverage ratio with and without capitalized interest. Now interest coverage ratio is EBIT divided by interest expense. Now for 2017, first we will be doing unadjusted and then we will be doing adjusted. EBIT over interest expense would be 544,865 divided by interest expense of 229,582. Your interest coverage ratio would be 2.37, and for 2016 it will be the same steps. 298,663 divided by 223,567. This number would be 1.34. For 2015, this number would be 58553 divided by 118330. So this number would be 0.49. Now if we are adjusting it, now over here we are assuming that we are not capitalizing but we are expensing the interest cost. If we are expensing the interest cost, then the EBIT, that is 544,865, would be reduced. The EBIT would actually be increased by your amortization of deferred financing cost of 2618. We would add 26182 over here. The reason being is, now if we are expensing, then there is no amortization. We amortize because of we are capitalizing the interest cost. So each year we are amortizing it. The point is that if you are expensing the interest cost, there won't be any amortization of deferred financing cost. So this would increase EBIT, and this would be divided by interest expense, that is 229,582. And we were also going to add capitalized interest, because at this point we are assuming that we are not capitalizing but we are expensing. So the interest cost or the interest expense would actually go up by 37,483, and your interest coverage ratio would go down to 2.14. Now it is expected this ratio to go down, because if we expense, then the interest expense, the rate of change in interest expense would be much higher than that of the EBIT. Now in 2016, your adjusted interest coverage ratio, this is again what we are trying to find out, would be 298,663, and we were going to add 48,345, and interest expense would be 223,567, and we're going to increase this by 29,033. And in 2015, same thing, 58,553, we were going to add 38,511 divided by 118,330 plus 134,838. Now over here the ratio would be 1.37, and over here the ratio would be 0.36. Now the thing that we need to understand is that the above calculation indicate that Melco's interest coverage ratio improved in 2017. So from 1.34 unadjusted went up to 2.37, and unadjusted from 1.37 to 2.14. Compared to the previous 2 years, in both 2017 and 2015, coverage ratio is lower when adjusted for capitalized interest. For 2017 and for 2015, when we adjust it and when we expense our interest, then the ratio actually goes down. Overhead, it went down from 0.49 to 0.36. Overhead went down to 2.37 to 2.14. It is only in this case it actually goes up, it improves. Second part, calculates Melco's percentage change in operating cash flow from 2016 to 2017, assuming the financial reporting does not affect reporting for income taxes. What were the effects of capitalized interest on operating and investing cash flows? Now, our cash flow from operations in 2017 was 1.1625 million, and in 2016 it was 1.118128 million. Now, cash flow from operation, the change in cash flow from operation would be 1,162,500 divided by 1,158,128 minus 1. The change is approximately 0.4%. Now, if we are expensing it, if we are expensing our interest cost, then the cash flow from operation would change. The cash flow from operation would actually, the change in cash flow from operation would be 1162500. Now, if we are expensing the interest cost, it would be minus 37,483, the capitalized interest, because now we are expensing and it will go out from cash flow from operation. And in 2016, it would be 1158128 minus 29033. Now, the change in cash flow from operation would be approximately minus 1, would be approximately equals to minus 0.4%, and rightly so, that if we are reducing our cash, now we are actually reducing our cash flow from operation. Why? Because now we are not capitalizing our interest but expensing. So once we expense, cash flow from operation goes down, and there will be improvement in cash flow from investing because the deduction of the interest will move from investing to operations. Now, as it is said, if the interest had been expensed rather than capitalized, financing cash flows would have been higher in all 3 years. Example 7, software development costs. You are working on a project involving the analysis of GHH software development company that establishes technical feasibility for its first product in 2017. Part of your analysis involves computing certain market-based ratios which you will use to compare GHH to another company that expenses all of its software development expenditures. So we need to adjust our statements from capitalizing to expensing. Relevant data excerpt from the company's annual reports are included in Exhibit 5. Now, this is a financial statement. Your revenue is 91,424 and net income is 9,492. Income tax 3,825. So tax rate in 2018 would be 3,825 divided by 13317, that is approximately equals to 28.72%. Now, the first thing we need to do is compute the following ratios on the reported financial statement for fiscal year with no adjustment for 2018. Next, determine the approximate impact on these ratios if the company had expensed rather than capitalized its investments in software. So first we need to find out when we are capitalizing, and then we need to find out when we are expensing. So the ratios are price to earning ratio, price to cash flow, and enterprise value divided by EBITDA. Now the first one is price to earning ratio. So over here we are given earnings per share, and the price for 2018 is 42. So price to earning ratio, first of all unadjusted and then adjusted. Unadjusted would be 42 divided by 1.4, that would be equals to 30. Now if you want to find out earnings, that is adjusted, first we need to find out the new net income. In order to find out the new net income, we need to find out what will be the operating income. So your operating income is 13317, or your EBIT. Now once we are expensing, so over here we have been told that the software development cost includes this investing actually includes software development expense, that is 6,000, and capital expenditure of 2,000, and amortization of capitalized software development expense is 2,000. So this is, we are capitalizing this, and this is your amortization. Now, in order to calculate your new net income, we need to understand that we need to first of all subtract 6,000. That is your part of your expense because that is being capitalized. Include software development expense, that is your 6,000. And now because we are expensing, then there is no need for amortization. So we need to increase this by 2,000 because that was the amortization. Now amortization takes place when we are capitalizing, but when we are not capitalizing, we are expensing, then there is no amortization. So your new EBIT, this is your new EBIT. In order to find out net income, we need to multiply this by 1 minus tax, and the tax rate is 28.72. So 1 minus 0.2872, and the new net income or the adjusted net income would be 6641. Earnings per share would be 6641 divided by 6780. Now we have been given 6780 is the total number of shares outstanding. So your earning per share, adjusted earnings per share would be 0.98 approximately. So your adjusted PE ratio would be 42 divided by 0.98, that is approximately equals to 42.9. So approximately equals to 42.9. So initially it was 30, now it is 42.9. Now we need to find out price per cash flow from operation. Now over here, price divided by cash flow from operation, we would have unadjusted and adjusted. Unadjusted would be 42 divided by cash flow from operation. We have been given cash flow from operation is 15007, and we have also given the number of shares 6780. So cash flow from operation, is 15007. But we need to divide this 15007 by the number of shares, so we get cash flow per share, that is 6780, and we get 2.21 for this 15007 divided by 6780. And once we divide 42 by 2.21, we get 19. So our price to cash flow from operation ratio is 19. Now we need to adjust. So price would be again 42 whole divided by cash flow from operation is 15007. Now we need to understand that we are expensing our software development cost, then it will not be deducted from investing but from cash flow from operation. So 15007 needs to be deducted by 6,000 and needs to be divided by 6780. This number would be 1.33. So 42 divided by 1.33 gives you 31.6. So this is your adjusted price to cash flow ratio. So initially it's 19, now it's 31.6. Now we need to calculate enterprise value divided by EBITDA. Let's go to the previous screen. So this screen. So enterprise to EBITDA, earning before interest, tax, depreciation and amortization, and this is your enterprise value. So enterprise value is actually market value of equity plus market value of debt. We don't have any market value of debt, and our market value of equity would be 42. This is your market value per share multiplied by 6780. So this would be, enterprise value would be 6780 multiplied by 42. Now your EBITDA, this is for unadjusted. We are capitalizing over here. So your EBITDA, earning before interest, tax, depreciation. So this is your EBIT, 13317. We need to add all the depreciation. So the depreciation and amortization, these are the two, depreciation and amortization. So we need to add 2000 and 2200, and we get 17517. So this is the EBITDA, 17517. So our enterprise to EBITDA ratio would be 6780 multiplied by 42 divided by 17517. So 6780 multiplied by 42 divided by 17517, that would be 16.3 approximately. Now we need to do adjustment. So adjusted ratio would be, the numerator will remain the same, 6780 multiplied by 42. Now we have the EBITDA, that is 17517. We just need to deduct the 6000. Why? Because now instead of capitalizing, we are expensing. So 6000 that was capitalized would be expensed, and our denominator would go down to 11517 because this is our EBITDA unadjusted. And just need to subtract 6000 because that 6000 is now being expensed. So the ratio would be 6780 multiplied by 42 divided by 11517. So it will be approximately 24.7. Now we are able to see that the ratios are being, the adjusted ratios are higher. Now they are depicting that if we capitalize and if we expense. So if we expense, the organization would appear to be overvalued. And if we are capitalizing, it will going to be, the ratios are low, so it will seem that it is undervalued. Because expense actually reduces the earning and hence it seems to be overvalued. So these are the ratios that we calculated, and interpret the change in the ratios. Expensing software development costs would decrease historical profits, operating cash flows and EBITDA that we have just stated. Because now we are not capitalizing, but instead we are expensing the whole charge, and would thus increase all market multiples. So JHH stocks would appear more expensive if it expense rather than capitalize the software development cost. It means it would appear to be more overvalued. If the unadjusted market-based ratios were used, in the companies of JHH to its competitor, then expenses all software development expenditures, then JHH might appear to be underpriced when the difference is solely related to accounting factors. Now again, if we capitalize, the company might appear to be undervalued, and if we expense, now expense would have three impacts. It would first of all reduce your earnings, it will reduce your cash flow from operation, it would also going to reduce EBITDA. So the company would appear to be overvalued.